Tunnel. My name is Vlad Karpel. I'm CEO and founder of Yellow Tunnel at Tradespoon. And today I'd like to go over prospect theory and what it means for traders. Before we get into prospect theory, please take a look at my bio. I was Executive Vice President, Head of Technology at Options Express from its inception through 2007. Options Express was an online broker-dealer acquired by Charles Schwab in 2011. At some point, the company was worth over $2 billion. I'm very proud of that experience. Since I left Options Express, I work as a consultant and investor in several financial technology firms here in Chicago. I've been trading my own money for over 15 years, managing and mentoring Tradespoon and Yellow Tunnel subscribers. And finally, I have a master's degree in computer science, specializing in technology and statistics. Since I'm going to go through some trading examples, very important to look at the disclosures. You can take a look at the disclosures here, compose it, and review it. All right, let's talk about prospect theory. What does it mean and what it means for developers, for traders? So according to Business Dictionary, prospect theory suggests that the individual place more emphasis on gains rather than losses. And as a result, will try to make decisions and that contribute to gains. Prospect theory lumps risk into two categories, those that contribute to gains and one that contribute to losses. This was developed by Daniel Kahneman and Amos Tversky. And the chart shows you basically that for traders, when we have a successful trade, and that's the x-axis, and y-axis is our wealth, our portfolio size, how much money we manage, then in terms of the effect that it has on us emotionally, gains will have less effect than do losses. So you don't have a linear relationship between having one successful trade where you make $50 versus one unsuccessful trade where you lose $50. The theory shows you that two events will affect you differently. So part of the prospect theory is value function. This is what you see, value. That's the value of your portfolio. You have a reference point. Usually this is your perception of wealth and your perception of how much money you're managing, so somewhere in zero. And then gains and losses. And you can see losses, if you experience losses, and the value will be disproportionate to the same gains and that you're having in your account. So something to keep in mind. Examples, what I found is based on your strategy. At Tradespoon, we're looking for 75% gains. So that means 3 out of 4 trades should be successful. So let's say we allocate $50 gain, $50 loss for each trade. So if you do 3 successful trades, that's $150. As long as one losing trade is less than $150, then overall your portfolio gains value. What we notice is that you can have 3 successful trades, $50 each, and you make $150, and you're going to be happy. Another case scenario where you also make $150, but let's say you do 10 trades. You do 10 trades, $50 each, $500, and they're all losing trade. So you did 10 trades, you lost $50 in each trade, you lost $50. And then the next 9 trades, each trade you made $50. Overall, the end result is the same, you made $50, but the way you arrive, the reference point, and the way you arrive to that $50 is completely different path. So the path gives you influence in terms of how you will feel about the end results. And if you have 10 losing trades and then 9 successful trades, you will totally feel different than if you have only 1 successful trade. So that's one of the examples. Another example is the other way around. You can have 10 successful trades, you made $50 each, you're up $500, and then you have 9 trades in a row where you're unsuccessful, and end result is $50. And all 3 cases scenario, you will feel different about your perceptions of gains and losses. Prospect theory after the value function also depends on the weighing function. Weighing function is very important concepts for traders. In a trading room, we do a lot of trades based on earnings. So earnings are, when the company announces earnings, you can look at the option data, implied volatility of options, and it can give you the probability of the stock trading in a certain range. And often when we pick a delta, when we sell, let's say, naked options or credit spreads was delta 10, we assume delta 10, it's probability is 90% that the stock will not reach that level. And if you sell iron condors and you look at the probability of 10% that it will not trade outside of the range, you automatically assume that it's 100% probability. You don't think about that probability can be 10%. Same thing with the stock market right now. On the other extreme, a lot of people would say, well, we placed the top, we're not reaching 52-week high, and SPY is around 302. Probability that we will stay below 302 level is 100%. But we all know there's no such thing as 100% or a 0%. What the research shows that when we're close to probability of the event 0 or 1, we tend to dismiss those odds. But when probability moves slightly higher from, let's say, 10% to 20%, an option moves from 10% to 20% to 30%, all of a sudden we see our risk in completely different. So again, nonlinear relationship in terms of probabilities and their outcome. What does it affect? Very common scenario is target gain and stop losses, right? We tend to value our gains differently than the losses. So when the stock goes in our direction, we cut it short very often because we want to book our gains. And when the trade goes against us, let's say you were short the market before the tariff announcement today, and all of a sudden your hedge goes against you, you wait longer to see with the hope that the stock market will continue to go in your direction. So you let your stop losses go a lot more than they should, and you cut your target gains shorter. This is a probably classic example from the prospect theory that affects the traders. And first step in dealing with this is recognizing these thoughts, right? We talked about labeling before and recognizing these thoughts and keeping a journal in terms of what your target gains were, what were your stop losses were before you got into a trade, and what they actually ended up when you exited the trade. Also very important to think about target gains and stop losses before you enter the trade. So then your emotion, now that you know that you view your target gains and stop losses differently emotionally, very important to write it down before you get into the trade, and that will help you avoid not, cutting your gains short and concentrate on a long-term perspective for your trading plan, right? The trading journal, trading plan will help you have a longer-term perspective that over a long period of time, let's say you're looking for 75% success, or you're looking for 20% success, but you're looking for higher return on investment. Whatever the numbers are, if you think about your trading plan, you want 3 out of 4 trades to be successful, then your job is to make sure that the 3 winning trades will outweigh 1 losing trade, and so on and so forth. So deciding about your target gains and stop losses ahead of time is very important. And I'm gonna leave you with some of the key concepts from my trading plan in terms of key support and resistance levels and how to hedge your portfolio. So now let's take a look at the market and see how we can apply prospect theory to current market conditions. We had an announcement today about delay in tariffs. Today is, let's make sure, August 13th. So you can see the market rallied. This is the longer-term model, 50-day perspective. Model provided a signal on Sunday 4 to 4 prediction higher, that the stock market will be higher. And overall, overhead resistance is 304 and support is 273. So you see that volatility is here to stay. I think the delay in tariffs is a positive news for the bulls. The question is, will the all-time high will hold? Will the 50-day moving average hold around 295 level? Or will we breach below 50-day moving average? So right now the model shows that going into October prediction, the stock market, the trend is going higher. Now looking at the stock forecast toolbox, the model shows different picture, that the short term for the next 10 days, the trend is to the downside. And I think the volatility is here to stay up until September 1st. This is where we will know for sure what the tariffs are and what percentage of Chinese imports will be taxed at what percent, whether it's could be 10%, maybe 20%. So uncertainty is here to stay. And the short term, the model shows that we will continue to make new lows. Looking from traditional technical analysis, looking at the S&P mini September contract, you can see we have been trading below 50-day moving average for 3, 6, this is 7th session. So that's pretty bearish for the market. We had a strong rally with overnight activity. We were as low as 28.69 on S&P mini futures. We rebounded all the way to 29.45 after the news and delay. So you can see the news drive the market. But if you don't spend too much time thinking about what you cannot control and you constrain on time on what you can control, then you have a clear defined support. Market is trading in the box between 27.78 on the futures, very close to the May low, and now 50-day moving average. So 200-day moving average and 50-day moving average has been a current support and resistance until we have new data to support a breakout of these support and resistance levels, and I would wait for confirmation. You know, if 3 days in a row we trade above 50-day moving average, then I would say bulls are winning. But if not, then I think the market will continue trading between 200-day moving average and 50-day moving average. Thank you very much. I hope this helps. Take a look at the prospect theory, spend some time researching it. Being self-aware is very important, recognizing how that we as humans deal with gains and losses differently. I think will help you taking a longer-term perspective on your trading plan and your overall approach to trading. Thank you very much and have a good day.